Hi everyone. I'll just give a minute for everyone who's joining. All right. Hi everyone. Thank you for joining MAGNiTT's Q1 2026 MENA VC update. This webinar is sponsored by East. Uh, I'm gonna leave this here for a minute for you to see your founder or investor. You have a barcode to scan. If you have a QR code to scan, a startup or a scale up, you have the other QR code to scan. So please feel free to check the pages and register to get early access or to apply for exhibition. As you know, this is MENA's Q1 Venture Capital update. We will run a couple of the events that took place during Q1 in the region, how those are expected to impact. Did the impact unfold, or are we still a bit far from the impact of whatever happened during Q1 on the MENA VC space? As you know, MAGNiTT is the leading private equity venture capital and venture data intelligence platform for emerging venture markets. We currently cover more than 34,800 startups and more than 10,000 founders. So, again, this webinar is sponsored by Leap East. I'm going to run back again the slide towards the end of the presentation for you in case you want to scan founders, exhibitors, or scale up startup QR code. Q1 2026 was particularly different. When we ended 2025, the data had a lot to say. The story around different macro support we're telling at the moment. 2025 is relatively low value. The question for us was whether this decrease impact oil revenues and how are the markets in the region going to react to this. We're currently at oil prices crossing the $100 mark in Q1 2026, and this volatility in oil prices is one of the biggest drivers of macroeconomic impact and policy, specifically in the region. Oil prices are one of the main drivers for revenues, particularly in the GCC. We did at MAGNiTT produce two reports that cover the impact of whatever happened at the geopolitical level on the MENA VC space, one of which captures three scenarios, of which was a baseline scenario, a short-term shock scenario, and a prolonged conflict scenario. The prolonged conflict scenario tends to be more of what we saw in terms of the timeline, so 4+ weeks of uncertainty. As we know, deals in the region do take 6 to 9 months to unfold. So whatever is getting closed in Q1 or whatever is getting announced in Q1 2026 was closed during Q2 and Q3 of 2025. So the numbers that we're seeing currently, negative or positive, are not the impact of whatever events happened in Q1. They're the result of whatever interactions happened before between Q2 and Q3 of 2025. We looked at 5 pressure points that tend to travel as a shockwave across the VC space. First of all, the oil-driven inflationary pressures. So as we know, with inflation increasing, interest rates tend to be impacted. The delays in rate cuts would compress valuations, would cause tighter liquidity. Interest rate expectations do impact capital availability. As we know, when interest rates are high, investors tend to focus more on safe havens relative than going into the riskier investment of a venture capital. Ideally, VC investments do take 7 to 10 years of wait the time frame to yield the return. So usually when interest rates are high, investors tend to focus more on higher return investments, faster return investments. Third is international investor risk perception. So as you know, we have a good share of around 49% of the capital deployed during 2025 was coming from international investors. How those investors perceive the risk is um, is a bit of a question mark. So we're currently Okay. So we're currently at a question mark of how those international investors are going to perceive the challenges that we're seeing in the region, given that the region has three types of international investors that are already set up in the region, and those are more likely to act like the regional or local investors, international investors who have invested in the region or have portfolio startups in the region, but are not based out of the region, and international investors who are new to the region and are the ones that are most likely to be impacted. The fourth is deal formation and frictions. As you know, multiple events were postponed. So travel constraints, new investor introductions are delayed. There's a slowdown in ecosystem events. All those do impact the pipeline moving forward and definitely investor risk aversion. So although local or regional investors do have a certain level of confidence in the region, however, it's a more of a period of a wait and see to see how this is how the events are gonna unfold. Geopolitical shocks did influence, so those were the transmission channels. What we looked at was the five pressure points. The first pressure point was basically international capital. With international capital capturing around 49% of the total funding last year, there is a question mark on how this is going to react to all 5 points. So, first of all, how it's going to react to increased oil prices, which do impact interest rates, perception of risk, and the frictions. Late stage funding, which is usually the bigger ticket sizes getting invested in the market. And usually late stage funding investments are the investments that aim towards either the M&As or the IPOs. So this quick return of those late stage investments is not going to happen. We know that 48% of the Series B plus investments during 2025 were coming from international investors. So the impact we're going to see from international investors is that definitely will definitely reflect on late stage funding. Deal pipeline, as we know, 7.3% of the total investments that happened at early stage between 2014 and 2024 did graduate to Series A, with the delays across the board of the investments happening, and with 68% of the Series A funding during 2020 coming from international investors. Delays in international capital investment will impact not only the late stage funding, but will impact all levels of the deal pipeline. Absolutely, exit liquidity is one of the question marks, especially as public markets are are volatile at the moment, and M&As are a bit influenced by what we see in terms of the valuations. Sovereign capital remains one of the strong pillars of the VC supporters in the region, especially with initiatives that we see that do support the VC space. But again, with the geopolitical tensions that we see, we do not know at this point how are the priorities of sovereign support gonna shuffle across. This was a bit of a throwback to what we've seen and how do we perceive this to be impacting different channels. How this is going to unfold definitely depends on how things are going to be moving forward, whether it's going to relatively remain stable moving forwards or any challenges are going to rise. We adopted a new approach of taking 10 key takeaways from the MAGNiTT Q1 reports. The team will be sharing links from the reports on the chat. We have a couple of high-level takeaways across. So we do set to ourselves a bit of a global comparative benchmark. Globally, we are seeing more dollars getting invested, however, at a smaller number of deals. So at the quarterly level, there is $186 billion getting invested globally. 43% of this is coming from a single deal by OpenAI. So $122 billion was raised for a single deal, which is 43% of the total funding that the global market did see. We are seeing an improvement in the value of funding in a year-on-year aspect with 108%. However, we are still, and even if we remove the impact of the $122 billion, we're still seeing the strongest Q1 since 2022. So since the comeback from COVID. However, at the level of the quarterly deal formation, we're at 6,599 deals, which is the lowest since Q4 2016. So the level of deal activity that we're seeing globally over 2025 and Q1 2026 is going back to deal activity that we were seeing during 2016. It is at around 61% lower than what we've seen at the level of the Q1 2022 peak. So the peak that we've seen post-COVID during the post-COVID year, we're currently at 61% less, and we're seeing capital concentrating into fewer yet larger bets, particularly focused on AI. Last year, as you know, MAGNiTT covers emerging venture markets. Emerging venture markets covered by MAGNiTT are Middle East, Africa, Southeast Asia, Pakistan, and Turkey. We've seen a slowdown of 13% year on year in funding last year at the back of a strong drop in Southeast Asia in the funding that was seen by the Southeast Asian market. The total EVM funding in Q1 2026 is at $4.1 billion already. Which is an increase of 122% compared to last year. This is at the back of an improvement in mega funding that was seen in Southeast Asia. So mega funding in the first quarter of 2026 already surpassed full year of mega funding in 2025 at the back of the improvement of 100 million plus deals that were seen in Southeast Asia. The MENA region was a baggage of mixed performances. We've seen a record year in 2025, $3.8 billion, 74% year-on-year improvement in the value of funding, 6% year-on-year improvement at the level of the number of deals. We did see improvements at all levels of the pipeline in 2025, from early stage up until late stage. What we are seeing currently is in a Q1 2026 to a Q1 2025 performance, we're at a relatively flat level of funding. Last year, we've had around $804 million getting invested. This year, we're at 799. However, compared to Q4 2025, we're at an improvement of 31% year-on-year, quarter-on-quarter improvement in funding. However, the drop that we're seeing is seen at the level of the number of deals. This comes at the back of multiple things that happen. Usually, the period that contains Ramadan and Eids in the region is a relatively slower period at the level of announcements. So we do tend to see relatively slower announcements happening during that period, especially in addition to what we've seen this year. Early in March, the war started, so there was a bit of a wait and see on what's announced or what gets during that. So we're definitely seeing moderation at the level of the number of deals, especially focused at the follow-on stages. So Series A and Series B are definitely seeing declines at the level of the number of deals. Pre-seed and seed are seeing up in terms of the activity. However, funding at the level of early stage or pre-seed and seed combined increased by 85% year-on-year. So we are seeing fewer early stage deals, however, larger early stage checks in the MENA region. Just to highlight how what happened Q1 will impact the space or how we perceive it, a bit of a comparison to what we've seen during COVID. So what we learned from COVID is ideally COVID in the region kicked off in Q1 2020. We know COVID is a global pandemic. It was not just focused on the region. So the whatever happened impacted not only the MENA region, but impacted the overall sentiment across the globe. However, what we see in terms of COVID, what we see in terms of the COVID lag window is something we can look at and implement currently. 120 was still a bit of a norm performance or even a positive performance quarter. Q2 was particularly pretty much the same thing. What we saw in terms of the drops happened during Q3 and Q4. So the deals that were supposed to be discussed or closed during the first and the second quarter of the year started reflecting towards the third and the fourth quarter of the year. And this brings us to what we think might be the impact of the geopolitical tensions on the region. The pre-conflict pipeline, which was closed, which was reflected in the Q1 and Q2 data, was closed between Q2 up until end of last year. The conflict disruption window, which is the March, April window, with few deals being initiated, will reflect at the level of Q3 and Q4. If this drop compounds with the summer seasonality, a slower seasonality that we see in the summer or Q3 is going to be the slowest quarter of the year, with the funding gap becoming more visible then. If things catch up, we're going to start seeing the uptick towards the end of 2026 up until early 2027. One very interesting key takeaway from what we've seen, which is something I mentioned towards the end of the two slides earlier, was that Q1 2026 transaction mix shifted in terms of the sizes. So we're seeing mid-sized round concentration. We're at 26% of the deals being closed at the 5 to 20 million bracket, which is the highest in the 5-year period. This was driven, as I mentioned, by larger seed checks. 41% of all the 34 seed rounds that were closed in the first quarter of 2026 were between $5 and $20 million. At the level of the stage analysis, we do see that the activity remains broadly at the level of early stage. 87% of the total deals was concentrated in early stage. Series A deals are still at relatively 9%, which is a flat-ish number compared to what we were seeing over the course of the past 5 years. And Series B is as well around the average of 4 to 6% that we were seeing between 2021 and Q1 2026. Growth stages, ideally Series A and Series B, remain the rounds that need to be monitored and are important to be monitored over the upcoming quarters. At the level of the countries, again, we do see KSA remaining the most active country at the level of deals, with 47 deals. All 3 most active MENA countries did see a double-digit decline at the level of the number of deals that are being closed. We are seeing we continue to see that 73% of the number of deals in the MENA region are driven by activity from KSA and the UAE, which is pretty much in line to what we saw last year at the level of the number of deals. We were at 71% of total MENA deals last year closed across those 2 countries. At the level of the value of funding, we are exactly at an equal share in terms of the capital deployed. However, just to highlight, Singapore did pave its way again into the most funded country across emerging venture markets. As I mentioned earlier, there was a major improvement at the level of Singapore, with triple-digit improvements that came at the back of an improvement at the level of the mega round. So this big upshift at the level of Singapore came from 100 million plus deals. The UAE saw 47% year-on-year improvement in terms of the value of funding, and captured 53% of the region's total funding, driven by Property Finder's $170 million deal. If we look at the non-mega funding, we see that UAE reported a 13% year-on-year drop in terms of the non-mega funding, while Saudi dropped at a slightly smaller than 62%, with 40% year-on-year. This drop came at the of the Series B activity that was super vibrant during 2025, compared to ideally Saudi did see $96 million at the level of Series B during the first quarter of 2025. Non-mega funding across both markets still remains above the slower periods of 2024 that we saw. Investors remain one of the most forward-looking indicators we can see. So MENA did see investors at overall the unique investor pool in the MENA region did see a drop of 27% year-on-year, with 107 investors coming from 50% coming from non-MENA based countries. Local investors account for 66% of all active investors, leaving international participation at only 34%, down from what we saw as 49% during last year. At the level of the value of funding, we did see that there was a drop from 49% contribution to the capital deployed, 49% of capital deployed from international investors to 26% capital deployed by international investors. There's a bit of discrepancy of how much we see in terms of the percentage of capital deployed across countries in the region. So while capital deployed from international investors in Saudi is usually somewhere between 30 and 35, capital deployed international investment countries like UAE ranging between 65 to 75%. So the proportion of international investors at the level of dollars invested differs between different countries of the region. In an overall perspective, we did see during the first quarter of 2026, only 26 of that funding coming from international non-MENA-based investors. GCC is 36% of capital deployed did come from UAE, while 20% of the investor pool had investors Saudi Arabia. So investors from Saudi and UAE remain the most active at the level of the number of investors investing in the MENA VC space and the total value of dollars invested in the space. We did also see investors from Singapore pave their way most active at the level of the capital deployed, 13% of the capital deployed coming from Singapore-based investors and 5% of the investor base being from Singapore, while US-based investors, which last year contributed to around 21% of the total capital deployed in the region, decreased to 5% of the capital deployed coming from those investors. At the level of industries, fintech continues to be the core pillar industry driver behind the ecosystem. Despite the double-digit drops across both, we did not see any mega rounds closed for fintech during the first quarter of the year, yet fintech remained the most active. It accounted for 31% of the total MENA region's funding, reinforcing its continued role as the deepest venture vertical despite the drops that we're seeing. Breaking it down into deals and funding, we do see gaming with a triple-digit percentage improvement to 22 deals. That was driven by mostly activity coming from Saudi Arabia and boosted by Mirak's fund that is focused on gaming. However, at the level of the funding, we do see real estate as well increasing by 968%, driven by $170 million deals by Property Finders deal. At the level of food and beverage, two deals that were each was for $50 million, one by Egypt's Breadfast and the other by UAE's Kitopi, did contribute to pushing up food and beverage across the board of the most funded industries. Advertising and marketing, IT solutions did also see triple-digit increases, but those were basically coming from smaller bases during 2025. One of the focus points that we were looking at, we've had a report published that focuses on AI for full year 2025, is AI. So AI remains a core support of the VC space. We do see AI quarterly funding globally reaching $226 billion. As I mentioned earlier, 122 came from OpenAI. There was another deal for Anthropic. Those were the top two biggest deals for the global VC space, and those were basically accounting for nearly 50% of the funding that the Q1 2026 globally captured. What we are seeing in the region currently, and which is not reflective of the overall activity across AI that we've seen, we are seeing a drop in AI funding year on year amidst the decrease in the number of deals. This comes at the back of different reasons. It could be delays in announcements that took place because of the Ramadan Eid and the events that were taking place. And in a retrospect, we could see more deals announced for the AI technology, because at MAGNiTT, we do cover AI as a tech and not as an industry. So AI is a tech that covers different industries across the MAGNiTT coverage basis. To close this out, we look at exits. So as I mentioned earlier, with all the tensions that we're seeing, exits in terms of IPOs, this could be not be the best period for whoever was in a pipeline to IPO to execute on the IPO, given the volatility that we saw, at least during the first quarter across the public markets. And for M&As, it's mostly an impact of whether the valuations that we're seeing at this point are a match between the acquirer and the acquired startup. M&A transactions after a record Q1 2025 of 23 M&A transactions. So Q1 2025 did have a record number of M&A transactions for a quarter at 23. We're seeing a 61% year-on-year drop to only 9 M&A transactions, marking materially slower than we've seen last year after the liquidity recovery that we've seen. However, we still see international acquirer interest across the acquirers. We've seen 4 out of the 9 startups having international acquirers coming from the UK, Singapore, Japan, and other countries. So we are seeing interest from international acquirers into the region. However, the volume or the number of M&As is still moderating. And by this, my Q update comes to an end. I'll leave them here for you to scan if you're a founder or investor to get early access, if you're a startup or a scale up to apply to exhibit. As I mentioned earlier, this webinar is sponsored by Leap East. Please feel to scan of the 2 QR codes to get to the script. I'll open the floor for questions. The team already shared the reports you can download. We have the report on the state of AI, which is the full year 2025 state of AI report. We have the one covering the 5 pressure points that I discussed during this presentation. We have another that covers the state of VC in MENA report. We've also launched a report that covers different tech IPOs that took place in the MENA region over the past 5 years. Any questions? Do you see GCC sovereign wealth funds withdrawing from US to other markets? Not necessarily. Not necessarily. I think it's a period of a bit of a wait and see to everyone. US-based investors remain core investors to what we see in the MENA region, specifically the GCC level of investor base and at the level of investor capital deployed. But I think what happened currently did put on hold what we were seeing in terms of the investor investments and the values that are getting invested. I do think there's a good connection between the GCC sovereign wealth funds and the US investor base in general. Any other questions? Outlook for Saudi for rest of 2026. Would the kingdom be 3/4 of MENA VC dollar volume considering the uncertainty elsewhere? Does the uncertainty push VC exits by 1 to 2 years? Ideally, compared to what we were seeing last year, Saudi and the UAE remain the core markets for the region. Ideally, together, they will definitely be accounting, give or take, to an 80% of the total funding in the region. So that's in terms of where we see this heading. I do believe that the activity is going to catch up for the different GCC markets moving into Q4. So I think we're already into Q2, but again, with the events being postponed, we're not expecting things to catch up that fast. But again, if things are stable moving forward, Q4 is going to be the quarter where things pick up, especially with the events. Does uncertainty push VC exits? VC exits, and given the way exits do happen in the region, we are definitely expecting that exits are one of the factors that are going to be impacted the most. How long are the delays going to be? Ideally, 1 or 2 years is a fair frame to consider. Yes. Thank you. There are some speculations that GCC, sovereign wealth funds, PEs, and VCs limiting investments outwards and focusing on local markets and domestic innovation, more localization and domestic investments over international. So ideally, if we want to consider that realistically, we tend to expect that there would be sovereign support to back up whatever was missed from international investments. But is this revealed in the data? This is not revealed in the data. We cannot assume that this is the reality, but we do expect that whatever is going to be missed from international investors, sovereign support will come to be backing up that gap in funding that we see. We do see sovereign support to a huge extent, specifically in Saudi and the UAE. We do see investments in Saudi specifically, 60 to 70% of the investments coming from local investors, which are to a great extent supported by sovereign wealth funds. Any other question? All right. Thank you so much for joining the webinar. This will be a recording shared as a YouTube link following this call, ideally tomorrow morning. Please feel free to reach out to me at farah@magna.com or research@magna.com for any additional questions you might have. Thank you so much. Please feel free to scan the Leap East QR codes. This will additionally be in the landing page of the webinar. Thank you so much.